joining us this afternoon. Sajjid Chinoy, Chief India Economist at JPMorgan, joins us on the show now. Sajjid, good afternoon. Was this policy commentary a little less hawkish than you would have anticipated, given everything we've seen take place in the backdrop of the last few weeks, whether it has to do with crude and commodity prices, whether it has to do with the slippage in the fiscal deficit in the budget, the MSP and other related rural and agri spending measures, or even the global upheaval that we saw just 24 hours ago, on account of rising inflation in other parts of the world?
Well, Menaka, it's possible that, some people thought the commentary would be a little more hawkish, but I think, let's just step back and realize there's a lot of uncertainty and a lot of near-term uncertainty that's picked up in the last week or so. So let's take MSPs, for example, a lot of speculation about how that will be done and what that does to inflation. But we just don't know when the government will implement minimum support prices, how they will do it, and therefore what the inflation impact is. So I think from a central bank's perspective, it would be wrong to unduly spook markets. We've already had a tough couple of months. I think what the central bank is saying is that there is new and increased uncertainty that shows up in their inflation forecast, that first half inflation is higher. And if you look at their fan chart, the risks are skewed firmly to the upside. So I think what the central bank is saying is, given the slack in the economy, for now, let's give everyone the benefit of the doubt. If and when this uncertainty gets resolved, we will act appropriately.
So in simple English, Sajjid, does that mean that in the next fiscal we might not see a turn in the interest rate cycle and that there may not be any hike in rates given the conditions prevalent today?
That's right. I think the best way, Menaka, to look at this is to say 1 year from now, where does the RBI see inflation? Because the first half of next year is conflated by the fact that you've got these statistical increases because of the HRA allowance. A year from now, that kind of rolls off. And what the RBI is saying is we see inflation around 4.5 or 4.6%. That is not a cause for alarm, which is why they've kept their stance neutral. Now, remember, this is an inflation targeting central bank. So ultimately, what matters is where do they see inflation going? Everything else, the currency, the fiscal deficit, minimum support prices, these are all ingredients. So as of now, I think the central bank doesn't seem alarmed, but I would say 2 or 3 key sources of uncertainty which could push that second half inflation higher if oil prices stay close to 70, if the rupee were to weaken, and if minimum support prices went up. I think right now the RBI is saying is we can't be making policy based on that uncertainty. If these variables move in a way that the second half inflation forecast were to go consistently above 5%, then one cannot rule out monetary tightening later in the year. As of now, they're saying is that's not our baseline view, and so it's not a given that interest rates have to go up anytime soon.
We saw a marginal retracement in bond yields just before the policy, and then after we heard from both the RBI and Urjit Patel in the press conference. Do you expect that this will help calm markets a little bit and, sort of the aggression that we've seen in the bond market will come off, given that any expectation of a rate hike in the first 9 months of FY19 seems to have been put to rest, at least now?
Menaka, I think the key word is at least for now. I think a lot of this uncertainty gets clarified in the next couple of months. The Kharif season starts in June. We'll have information about minimum support prices before that. We'll know in the next couple of months whether oil stays at 70 and what happens to the rupee. For now, you're right. I think bond markets are heaving a sigh of relief. But I won't jump to say that markets will necessarily inflect, because the problem with the bond market is not so much that they were expecting rate hikes anytime soon. The problem is a more fundamental one of a demand-supply mismatch. That at this point in time, banks are seeing weak deposit growth. They've already bought many more bonds than they have to. We're seeing that the RBI, given where the liquidity situation is, will not be buying bonds anytime soon, and foreigner limits are full. So given the quantum of supply that's going to come on stream in the coming months, the question is who is going to be the marginal buyer? I think that's the stress in the bond market more than expectations of a rate hike or otherwise. And I think that fundamental mismatch doesn't go away anytime soon.
Sajjid, Neeraj here, you were of the opinion, I know pre-budget, that the budget probably needed to do something to bring down the bond yields because corporate India's borrowing cost has gone up net about 50 basis points, a few points here and there. Now, the budget being out of the way, can the RBI and should the RBI do something further to at least bring down the bond yields? Because while the RBI doesn't need to hike interest rates because the yields are already up, there is probably a need for the yields to come off a little bit from the elevated levels that they are at.
I'm going to take a slightly contrarian view here. The RBI is an inflation targeting central bank, and so I'm of the firm belief that if you only have one instrument, which is your overnight policy rate, you can't be having multiple objectives here. I don't think the RBI should be in the business of targeting any asset price, whether it's bond yields or the equity market or the rupee, for example.
No, I agree with you. No, I'm saying, so Viral Acharya did say to that effect, which is I was asking you, that should the RBI and will the RBI do so?
No, so I think that ultimately the bond market is reflecting fundamentals, this demand-supply mismatch. Now, what can change that? It's possible that in the month of April, that when the FPI limits are reviewed, those limits go up. I'm of the opinion that if FPI limits are to be increased, it should first be in the corporate bond market, and if you do it in the GSEC market, that could cannibalize demand for the corporate bond market, but it's possible that those FPI limits may increase a little bit. I think that's one instrument that they have at their disposal. But I think fundamentally we have to realize two things, that given the global economy and given where interest rates are moving globally, yields will be under pressure in India. And secondly, rather than trying to look for new sources of demand which may be volatile, the key is that we have to cut back on supply. So I think the best thing we can do this year is give the markets assurance that this year's fiscal deficit number will be met, that later in the year there'll be no pressure on market borrowing, increasing market borrowing. And secondly, you've seen states actually double their quantum of issuance in the last 4 years. It's important that states also remain disciplined. I think if states were to remain disciplined, if the government were to double down on this year's consolidation, I think that in the medium term will do more to assuage market sentiment than a stopgap measure like increasing FPI limits, which may have an impact for a week or a month, but again don't address the fundamental mismatch.
Your point well taken. We're heading into market close, Sajjid. So quick last question from you. Is there anything else that stood out in the policy document? I think except for the last bit of emphasis on this being a nascent recovery and that it being, it needing to be nurtured. There's nothing else that stood out for me, besides what we already discussed or even from the press conference.
No, that's right. I think what the RBI is saying is that we have this challenging environment where on the one hand the recovery is very nascent, output gaps are still negative, utilization levels are still low, so we don't want to jump the gun. On the other hand, there are a panoply of risks to inflation that are emerging. So it's going to be a very delicate balancing act for policymakers, both the government and the central bank in 2018.
All right, thanks very much for that, Sajjid Chinoy, Chief India Economist at JPMorgan.